Colleagues, I'm doing part 2 to this video. I did the first part where I was mainly talking about the trade as I saw it before I took the trade. What was I looking at? I explained the divergence concept which I saw in the groupings. These groupings there, that they were grouped there, and also the weekly chart was showing a similar grouping. Great trade. Now I want to talk about the chart, a little bit of the chart analysis. Then I'll go to the options setup which I used for this trade. The first part on this is key to watch the Bollinger Bands. Whenever they squeeze, after the squeeze, there's a great move. Whenever they are furthest apart, after that furthest apart, but they usually move. But squeezes are the best indicators, and these ones are furthest apart. Look at them using these groupings. If you find these groupings and there is a clear divergence, then it's easier to deal with. But I won't spend much time on chart analysis, but this was a great chart to get into at the time of the trade. Then the second part is this part here where I did an actual trade setup using options. I did not use a complicated option structure. I used a very simple one, which is called the vertical debit, where I bought puts and sold further out of the money puts, because I expect this to go down. But the key difference is here. That's why I combined this chart analysis and option setup. It was there, and I call this a top for me. Then I was expecting to go short. How do I benefit by going short? If I just bought a put, it would be way expensive, and its trajectory is not that great for me. And it's very difficult buying a put and making double or 5 times what you have done. So I wanted at least a 5 back out of this trade. Okay, then how did I structure it? You can see this green line, this dotted green line here. It's even clearer on the weekly chart. Let me pull the weekly chart. Oh boy. This is a major resistance, and it broke through due to earnings. But I believe it's not a strong one, and it's a false breakout, and it will come back. Why I call it a false breakout? The stuff is already grouped up there. RSI is showing divergence with price, and the Bollinger Bands are wide apart. If they were squeezed like this and were that level, I could say it could go either way. Like in this scenario here, it could have been viewed as going either up or down. But we had a grouping, so chances were it will go down. Also, once I saw this Bollinger Bands flip over, I would know that it's going to go down. But here, the Bollinger Bands are furthest apart. Like in this scenario here, when they're furthest apart, you know you're heading for revision to the mean. It's likely to go back into the Bollinger Bands. It's not likely to continue going away. We held them there. Once they were there, and there was a grouping there, I knew we're supposed to go back. Same scenario here. We are sort of furthest apart. We have grouping there, and we have divergence. I expect it to come back into the cloud, within the Bollinger Bands to the midpoint or so. So if I was calling this, not just trading it, I would have said I expect price to come back to the 38 range. When we're here, I'm expecting price to come back and sit on this floor of the Kijinsen, which gives me a price of 38, call it 38. So that's where I would expect the price to come to based on this weekly chart. And how long would that take? This took 1.5 weeks. We can expect a month or so to come to this level. But how did I put the trade on? I picked this 44 level, this previous resistance, that it will come back, either test it or break through a bit. That's where I would make money. How would I make money? That's why I put this trade. It was trading around this point, around 51 there when I placed the trade. But I did not buy as they usually teach this debit vertical. They usually tell you to buy within this one standard deviation here. They will tell you that buy at the money and sell out of the money puts, or buy deep in the money and sell just at the money or something. But they want you to play within this one standard deviation. I play way out, 3 times outside the standard deviation. And what was the payout of this trade? Let me just go into this one. So when it was at 51, I went and bought puts at 54. You can see them there. The bought puts were at 54. I sold the 44 ones. So if you do your maths from 51 to 44, it's about 11% or so. Let me just do a quick calc there. 51 minus 44, that's 6. So we have a 6 divided by 51. That is about 11% move. So I went and bought puts 11% out of the money. So this, if you are taught by option gurus, they will teach you based on the expiry of this option setup. So I would have bought puts 11% out of the market. That's way low, expecting this share to move for 11%. Basically, what I was saying was, it's trading there now on the white dotted line. I expect it to come and trade here. On the weekly, it looks fine. If you look at this logic on the daily, it becomes very tricky. And most people will start getting scared that it's unlikely to come back to be in the money. I really don't want it to be in the money for me to make money. It can move down. As long as it's moving down somewhere here, I will make money. If it gets to this, I will make a killing. Beyond that, it will be perfect. But that's what it is. I moved what puts here, sold further. What puts at 45, sold at this dotted line of 44. So I'm expecting this stock to come to these levels. But here's the key part about this option strategy, which people don't get. They are taught based on the options when they close. I'm not going to hold this thing up to the close. As it moves on a daily basis, if I hit my targets and I realize that the chart analysis is telling me a different story, I close the trade. So even if you bought it here all the way out of the money, these puts, if I close them earlier somewhere here, and this was the chart for that period, I would be making all this money, difference between this dotted line and that one. I'll give you an example about currently, after just entering the trade yesterday and trading for almost half a day or so, what profitability it is. So this option structure makes money as you move. If it breaks above that, I will make a huge killing, but I want to illustrate that. It moved from 51.1 to 50.4. That's a difference of 0.63. That's the move from yesterday, from the moment when I entered to the moment up to the moment when the market closed. The move was just 1%, 1.2%. That was the move. But how much did I actually make on the trade in that period, in that half a day or whatever? I made 78%. I bought the option. The option structure cost me 70 cents. It was worth 55 by the time it closed. 55 by 70, 78%. So the stock actually moved down 1.2%. And I'm already at 78% return. I could have easily closed this and kept doing this and every day grabbing about 78% per trade. Those are great results based on one day only. So why am I saying this? I'm just trying to illustrate the point that just because I bought the structure out of the money, way deep out of the money, it doesn't have to get to that position for me to make money. Already in a day, I've already made 78% return. That's the key point. As it keeps going down, I'll make lots of money. How is this possible? there's a technicality which I used here. When you buy options, this vertical spread, way out of the money. It costs so cheap because those options are highly unlikely to ever close in the money. So the cost of getting into the trade is very small and the returns are huge. It's not very clear here, but I'll open the actual setup. But this trade cost me only $70. If it goes below 44 and keeps going up to close of this trade, when it's near close, I'll make almost 1,000. 17. I'll make $930 based on a cost of $70, not 700. $70 with expected return of 930. When you do the maths, here it is here. Did I do that maths? Okay, I'll quickly do it. The expected return, maximum expected return is 930. What did it cost? It cost me 70. This is a potential 13 bagger. Okay, potential 13 bagger, 13 times what I get. So I'm placing this trade with the understanding that if all goes according to my plan, I'll make a 13 bagger, 13 times the cost of putting the trade. This is $70. This is $960. Big difference there. And even if it drags almost halfway somewhere here, by the time I pull the trigger and I've made, say, 500, let's suppose it's halfway there, and I've made about 500, that's still major. Because I'm saying 500 divided by 70, that's a 7 times bagger. So for me to pull a 5 bagger on this trade, I don't need it even to get to half there. Anyway, along this trade, I can easily pull a 5 bagger. Depends how quickly it goes down and how is the volatility. But it's very easy to get a 5 bagger. And based on this chart, on my weekly chart, this 13 times 13 bagger is very doable because this is the major resistance. That's where the trade, if it turns down, is the first point of target. And it can even go better down. And usually the technical analysis is that if there is a divergence, the price is likely to come and touch the base, the value of the divergence on price. So there is a likelihood we can come close to 20, 18. If not, then we look at the levels. This is the first level. This flat Kitchensen is the second one at about 38. I will already be making my 13 bagger. And the next part is the cloud somewhere here, around 33. That's the target which I would think is most expected. But whatever happens by then, I would have made my 13 bagger return. So that's what I wanted to illustrate there, that the reason why I put it so far out of the money, I know I'll be making money all the way here. Can easily make a 5 bagger before it gets even to 45. That's how the trade is structured. That's why this is so close there. But let me go to my monitor and show you the trade there. There it is. There's where I got that 55. Already by close of the day, I was making a profit of 45 based on a trade which cost me 70 cents, $70. Let me just try and pull the analysis. There we are now. I'm no longer on the picture. This was the picture. I've closed the picture. Now I'm actually on think or swim. I'm live now. If you watch the time, it's rolling. 29, 30, 31. Yes, I'm live. This is the trade setup as it is now. in the second day, a day after I placed the trade. So here's what I was talking about. Keep looking at this corner here. This corner here shows the date and the expected receiver. If it was to close today, at the top, the top blue line, this one, I would be making, the maximum I can make is 930. What did it cost me? Look at the blue line here and look at this far end here, somewhere here where 930 is now. You will see a 70 there. Yes, as you can see there, that's where the 70 is. The 70 is the blue one where we expect it to close. If it was to close at this position, it would cost me 70. That's what it cost me to put the trade. That's the worst I can lose. The worst I can lose on this trade is $70. The most I can make is 930. That's the benefit of buying or putting option structures which are way out of the money. The cost is barely minimum and the returns are extreme. If this works out, I'll be making a return of 13 times my capital which I would have put. These are the trades I play in. And along the movement, you keep making money. You can close at any given time. Like I showed that currently, if I was to close this, I would come out with the 55. If I come out with 55, that's where I did this calculation for you. Where is it? I did the calculation. Okay. Yeah, here it is. Where I said 55 divided by 7. 55 is what it's worth, my trade is worth now. Divide by the 7, what it cost me, it's a return of 78%. That's why I'm saying, even if I were to close this trade now, I've already made 70% return, 78% return in just half a day. So at times, even when people want to play the income game, they keep confined to the old teaching that buy close to the money is the safest, is what? This is a month away. It's very safe. Even if it started moving that way, I can construct a butterfly or something here to protect myself and break even. But it's already making me 78%. And look at this. It's barely left the zero line. And it's already giving me 78% return. So this trade is great. That's how I placed it. It's simple. Just buy a vertical spread, but put it out of the money. But this game needs somebody to fully understand your charting analysis and where you expect this thing and how long do you expect it to move to that level. My personal view, within a week or 2 weeks, would have hit this target. But I'll do that review later. But I just wanted to spend some, wanted to spend some real time looking at the trade, how I structured it. This is cheaper than a straight put. This is cheaper than, it's slightly more expensive. No, it's even cheaper than a butterfly. Because a butterfly, I'll have to buy another leg there. Yes, this is slightly cheaper than a butterfly. And unlike a butterfly, the butterfly will only make a profit within a limited region. This one, as long as it keeps moving downwards, I'm making money. And if it closes anywhere below 44, I make maximum return of 13 times my initial investment. This can be more profitable than somebody who bought a put and the trade goes to 37 or so. They are unlikely to even make 10 times their return. But on this one, I'll definitely make more than 10 times return if it stays and closes anywhere above 44. That's my trade. That's the trade I took. Looking at it, just a small move from there to there is not a trade which somebody can imagine to give you a 10 bagger. But with this construction and the guts to buy out of the money puts structures, you will make serious money. I'm looking forward to the trade. That was just a part 2 of this analysis. I'll pull a part 3, but I've tweeted a lot about 10 baggers, 5 baggers, but I never took the time to show an actual trade. This is an actual trade. This is a real trade going on, connected. It's not a dummy account, but I used a very small amount because I'm trying to explain it from somebody's perspective with a small account and what would it mean. If this account is 1,000, then I only used $70 out of 1,000 and I'm likely to make 1,000. So I can easily double my account size by only exposing less than 10% of my capital. If I pull 3 or 4 of these and the 2 of them come off, I would have paid in full. If I pulled 3 and 2 of them come right, I'm doing fine. Even if I put 3 of these and 2 of them don't come right, let's say I lose 200 on those 2 which do not come right, and I make this 900 on one like this, so it will be 900 minus 2, it will be 700, and that will be a great return. 700 is 10 times my capital. 700 is about 70% of my net capital after losing those 2 trades and only pulling one. But chances of losing the trade is next to 0, because I look at this on a daily basis and I can do adjustments. During this trade, if the need happens that we do adjustment and these things start misbehaving, I will record an adjustment of how I play the adjustment. But currently, we seem like we are moving right. We'll see how it opens. I'm hoping it opens gapping down. If not, it can drag itself sideways for some time. I have a month to play around. That's how one can pull trades, which will give him 5 bagger returns. 5 bagger is about 500 times what it costs you to pull the trade. And I'm looking at this one being one of them. I'm going to be running this account and see where we end up with it. It's 2 PM Sebata. I thank you.